free money work? Ray starts off his post by saying money is free for those who are creditworthy because the investors who are giving it to them are willing to get paid back less than they give. More specifically, investors lending to those who are creditworthy will accept very low or negative interest rates and won't require having their principal paid back for the foreseeable future. Then he goes on to say that they're doing this because of the enormous amount of money that's being pushed on them by central banks. The central banks are making futile attempts to increase economic activity and keep inflation up. So how does all this free money work? I know you hear it a lot in the media and you say, my gosh, last time I went to go get a car loan or a mortgage, they're not giving me free money. But here's how it actually works. So it starts right here with the Fed and quantitative easing. They print up all this money out of nothing, buy the bonds from the banks, the financial institutions, and the funds. So this money that's printed out of thin air goes to the bank. We'll call this bank Wells Fargo. They do lend out some of that to people like you and me, but the majority of that piles up and they lend it out to other institutions like the investment bank. The investment bank takes that money, they lend it to hedge fund. Keep in mind that the investment banks, the hedge funds, and mutual funds are also getting money that's newly printed from the Fed through quantitative easing. So the money's really staying in the financial system. Then a lot of these funds will buy more treasuries from the government, more government debt, and around the world, a lot of the bonds that these governments are issuing have a negative yield. That's where Ray's talking about free or less than free money. The government takes that, they spend it, of course, like we know they do well. That money comes down here to the government worker, which deposits it right back into Wells Fargo, where we started. And keep in mind, when you give your money to the bank, you are lending them your money. You become a creditor and they become a debtor. So you're lending your money to the bank at whatever interest rate they are paying you, which, let me guess, your bank is paying you 0% interest, or very, very close. So what you're actually doing is you're lending your money to the bank at a negative real interest rate, meaning that if they're paying you 0 or 0.5% and the rate of inflation is 2%, you're actually giving your money to them and you're expecting less money or purchasing power in return. Exactly what Ray's talking about. So that money goes back into the system and the cycle starts again. Not all of it stays in this cycle. As an example, the investment banks will lend a lot of money to pension funds that need a 7% return in order to meet their obligations. And the only way they can get that 7% return is if they borrow money and they lever up. They have to use leverage in order to get this. And then they look for what they consider a quote-unquote safe return. And they'll buy debt of corporations because that's the only way that they can get even close to this 7% return. So the corporations take all this super cheap money that they get from the pension funds. What do? They buy their own shares back. So those shares go back to the company, and this is done with all this free money that the Fed just printed out of thin air. That's what props up the stock market. And if you go back to 2010, you'll see that almost 100% of the gains in the stock market have been a result of corporate buybacks. This is how this free money system works, and you can see it's just pure financial engineering. Step number 2 is, why isn't this money getting into the real economy? Let's go back to Ray's post. The reason this money that is being pushed on investors isn't pushing growth and inflation much higher is that the investors who are getting it want to invest it rather than spend it. This is creating a pushing on a string dynamic that has happened many times before in history, though not in our lifetimes. And this was thoroughly explained in my book, Principles for Navigating Big Debt Crises. And if you guys want to check out the book, we'll put an affiliate link for Amazon in the description below. Great read and great way to support the channel. But what he's really talking about is this system. The way it used to work was this money would come from the banks, the hedge funds, the private equity, the investment banks. And instead of this financial engineering craziness, it would go to real businesses that would take that money to expand. They'd hire workers. They would buy machines to increase productivity. That's the way a free market economy is supposed to work. And the reason they're making this decision makes a lot of sense. They have an option. Option number 1 is they can keep it in this financial system where they're getting, let's say, an 8% return on their money. Option number 2 is the old way, which is true capitalism, and that might have traditionally given them a 10% return. But now we've got the wild card of the Fed put, and that's basically the Fed propping up the market. So these investment banks, these decision makers will say, listen, I would rather take this money and have it floating around here in the stock market because I know the Fed has my back. It's going to have very little risk. Then inject it into the economy and subject myself to a lot more risk. Additionally, right now they're probably not getting 10%. They're probably getting more like 5 to 7% on those commercial loans. So it really doesn't make sense. And all of this goes back to the Federal Reserve trying to micromanage the economy. Step number 3, asset prices go up and expected returns go down. As a result of this dynamic, and he's referring to the dynamic we outlined in step 1 and 2, the prices of financial assets have gone way up and future expected returns have gone way down, while economic growth and inflation remain sluggish. And I want you to pay specific attention to this next part, especially if you're invested in the stock market. Those big price rises and the resulting low expected returns are not just true for bonds. They're equally true for equities, private equity, venture capital, though these assets' low expected returns are not as apparent as they are for bond investments, because these types of investments don't have stated returns the way bonds do. As a result, their expected returns are left to investors' imaginations. Key point. To understand what Ray's talking about in this segment, let's look at the Shiller PE ratio of the S&P 500. And for those of you who don't know what a PE ratio is, it's just price to earnings, and that means how much are you willing to pay for the profit of that business. As an example, if the business is making $1 million, if it was trading at a 5 times PE ratio, you would be willing to pay $5 million for that business. If it was trading at a 40 times PE, you'd be willing to pay $40 million for that same business that was producing $1 million in profit. This chart goes from 1880 to the present day. And you can see it online. We'll post it up here. It's not just a dot plot. It's much more thorough. But the PE ratios range from 5 to 45. In 1920, it was all the way down here at 5. So for that $1 million company in 1920, people were only willing to pay $5 million for it. But then going up to 1929, we know in the height of that bubble, people were willing to pay $30 million for that same company. Going down to 1980, when we know stocks were really cheap, people were willing to pay $7 million for that company. In 2000, we know the height of the dot-com bubble, people were willing to pay 40+ million for that same company. And then I want you to notice here in 2007, we dropped all the way down to where? The historic trend line. And as you guys know from my videos on the housing market, it's crazy how things always tend to mean revert. Since then, the Fed's juiced the market, and now we're all the way back up to paying $30 million for that company, same place we were in 1929. So what Ray's saying is if the PE multiple is way up here at 30, you can't expect it to go to 60 or 100. So the future expected returns are going to be a lot lower if you're buying at a 30 PE than if you're buying at a 7 or a 5 PE. And what I wanted you to pay really close attention to is when he talks about the fact that bonds are fixed income, but equities are not. They're limitless. They can go to the infinity and beyond, like Buzz Lightyear. And this captures the imagination of all these people. And that's why these PEs and these bubbles can go so high, because people forget about reality, but they start buying based on emotion and their imagination and invest in companies like Uber and Tesla. Step number 4, we get into FOMO and recency bias. Because investors have so much money to invest, and because of past success stories of stocks of revolutionary technology companies doing well, more companies than at any time since the dot-com bubble don't have to make profit or even have a clear path to making profit to sell their stock, because they can instead sell the dreams to those investors who are flush with money and borrowing power. I want to make sure everyone's clear. When he's talking about investors, he's not referring to the retail investors like you and your buddies that have a Robinhood account or maybe some stock in your 401k. He's referring to all those institutions that we talked about in step number 1, the beneficiaries of the quantitative easing and money printing. And when those groups see the businesses like Amazon and Apple and Microsoft, they're human beings and they have FOMO and recency bias, and they think to themselves, oh my gosh, if I just would have got in at Amazon when it was only $10 a share, or Apple when it was $15 a share, or Microsoft, my gosh, you could have bought that at one time at $7 a share, or whatever it was. They remember that, so when they get that cheap money that they have to do something with, they try to find these unicorns, and that's what drives the PE multiple, especially on the NASDAQ, to levels that we haven't seen since the dot-com bubble. Step number 5 is take my money or else. And this is where Dalio's insight as a fund manager is priceless, because we can't see behind the veil, but he can. He says there is now so much money wanting to buy these dreams that in some cases, venture capital investors are pushing money onto startups that don't want more money because they already have more than enough. But the investors are threatening to actually harm these companies by providing enormous support to the startups' competitors if they don't take the money. What happens is the funds get the enormous amount of money from money printing and they invest in, let's say, Uber. But then Uber says, no, we've got plenty of money. We don't need any more. And they'll say, no, you will take our money. You will sell us equity, or else we'll take that money and invest it with your competitor Lyft. And Uber says, oh man, I don't know what to do now. I'm between a rock and a hard place. Fine, we'll go ahead and sell you some more equity and we'll take your free money. And you may be asking yourself, why on earth would the fund ever do this? This makes no logical sense. But it does if you think about the fact that these funds have investors themselves that are demanding that they invest. They can't have 50% of their fund in cash because these investors are paying them fees. And the investors aren't going to be willing to pay them fees if they're just going to sit on cash and not invest the money. Step number 6, while all this other stuff is going on in the background, government debt is getting out of control. Large government deficits exist and will most certainly increase substantially, which will require huge amounts of more debt to be sold by governments, amounts that cannot naturally be absorbed without driving up interest rates at a time when an interest rate rise would be devastating for markets and economies because the world is so leveraged long. What he's saying there, and we'll use the US government as an example, they've got 23 trillion in debt and they're adding $1 trillion to that every single year. In fact, $1 trillion plus. This drives up the amount that they have to pay in interest, and you have this compounding effect that the market sees. And when the market sees that, they don't like it. They know they have to print more money, so they charge them more interest because they see inflation coming down the road. It looks a lot like this. If this black circle is the amount of debt that a country has, and this green circle is the amount of tax revenue that they have coming in to service this debt, the market can see that and say, okay, well, this is sustainable, so we're going to lend them money at 2%. But if that debt grows a lot faster than the amount of income coming in, the market says, well, wait a minute here, this is getting a little scary. We're going to charge them 4% to lend them money. And it keeps on going. When it gets this big, 8%. And we get to a certain point where the market sees this and says, no way can they sustain this without printing more money and creating inflation. So we're going to charge them 16% now to loan them a dime. And I'm just using this 16% as a hypothetical number, but you can see that it illustrates my point. So if those rates do go up to 16%, remember we've got record high corporate debt, consumer debt, sovereign debt. So how can they afford to pay their debts if the interest rates go from 2 to 16%? The answer is they can't. It would crush U.S. business, crush the consumer and crush the government at the same time, which would completely implode the economies. And you notice I used plural here because it wouldn't just be the United States, it would be every single economy that has this problem, meaning the entire Western world. Step number 7, Dalio outlines my inflation doom vortex, which I described in my inflation video. We'll put a link below. In fact, when I was reading this post, it's so similar to what I've been saying. I was thinking to myself, my goodness, I think Ray Dalio must be a subscriber. I think he's watching my videos. So if it's good enough for Ray Dalio, it's good enough for you. Hit the subscribe button right now. Where will the money come from to buy these bonds and fund these deficits? It will almost certainly come from the central banks, which will buy the debt that is produced with freshly printed money. This whole dynamic in which sound finance is being thrown out the window will continue and probably accelerate, especially in the reserve currency countries, US, Europe, and Japan. Dalio is talking about my inflation doom vortex. If you haven't seen it, it's where inflation picks up in the United States. That creates rates at the long end of the yield curve to go up. That crushes the economy, and that means that the Fed has to print even more money to try to keep those rates low, but that creates more inflation, and you can't escape this vicious cycle unless you jack interest rates up Volcker style. But if you do that, the result is going to be 1,000 times worse than it was in the early 80s because the debt that we have in the system is so much higher today. Step number 8, the pension crisis. At the same time, and he's referring to the previous steps, pension and health care liability payments will increasingly be coming due, while many of those who are obligated to pay them don't have enough money to meet their obligations, i.e. pension funds. Right now, many pension funds that have investments that are intended to meet their pension obligations use assumed returns that are agreed to with their regulators. They're typically much higher, around 7%, than the market returns that are built into the pricing. As a result, many of those who have the obligations to deliver the money to pay these pensions are unlikely to have enough money to meet their obligations. What Dalio is saying here is you have all these pension funds, not just in the United States, but around the world, that have these workers that have contributed to this pension fund either directly or indirectly through their employer, and they're expecting the pension fund after 25 years to give them a lot more money than they put in. In fact, they're building their lives around this money that they think they will be getting. In order to do this, the pension funds have to produce a 7% return, which is totally unrealistic. Why? Because the Federal Reserve has kept interest rates so low for so long. But I don't think Dalio takes it far enough. If you've been watching my videos, you know that these pension funds are investing in corporate debt. The corporations are taking this money and buying their own shares back. So if the stock market goes down, this whole house of cards tumbles. The Fed knows that, and that's why they have to keep up the QE and the money printing. Step number 9, the Ponzi scheme is revealed. Those who are recipients of these benefits and expecting the commitments to be adhered to are typically teachers and other government employees who are also being squeezed by budget cuts. They are unlikely to quietly accept having their benefits cut. While pension obligations at least have some funding, most healthcare obligations are funded on a pay-as-you-go basis, which is a nice way of saying a Ponzi scheme. And because of the shifting demographics in which fewer earners are having to support a larger population of baby boomers needing health care, there isn't enough money to fund these obligations either. So not only are the pension funds completely screwed, but so are the health care funds that are basically a Ponzi scheme, and we all know how that works. You've got to have more people paying into the system than are actually receiving benefits. But to Ray's point, once this dynamic shifts, because we have a large glut of population retiring, meaning the baby boomers, we're going to have fewer people paying into the system and more people getting the benefits, or I should say trying to get the benefits because there's just not going to be any money there. Step number 10, and this is where it gets really, really ugly: social unrest. Since there isn't enough money to fund these pensions or the healthcare obligations, there will likely be an ugly battle to determine how much of the gap will be bridged by 1, cutting benefits, 2, raising taxes, and 3, money printing. And this will exacerbate the wealth gap battle. So when the workers see that these pension funds and the healthcare schemes can't fund their liabilities and can't keep the promises that they made to those workers, they're going to get pissed. They're going to grab the pitchforks and they're going to hit the streets. The government will only have 3 options at that time: cut benefits, raise taxes, or of course, print money. Step number 11, the fiat currency endgame. While none of these paths are good, printing money is the easiest path because it's the most hidden way of creating a wealth transfer, and it tends to make asset prices rise. After all, debt and the other financial obligations that are denominated in the amount of money owed only require the debtor to deliver the money. Because there are no limitations made on the amounts of money that can be printed or the value of that money, very important point, it is the easiest path. The big risk of this path is it threatens the viability of the 3 major reserve currencies as a viable store of value. What happens in this scenario is the government looks at these 3 options and says, oh my gosh, money printing, that is by far the easiest. So the Fed gets the money printing machine running on all 8 cylinders, and they've got money going everywhere. And the government takes that newly printed money, they put it into the pension funds. So these workers, the angry workers that were there with the pitchforks, are like, okay guys, okay, time out, time out. We promised you $1,000 and we'll give you $1,000, no problem. So the worker says, okay, I think that's fine, but what they don't realize is now that $1,000 will only buy them a loaf of bread. And that happens not only in the United States, but in Japan and Europe as well. Meaning the reserve currencies that people have used as a quote-unquote store of value plummet because of all of this money printing. And when these currencies plummet, so do all those people's purchasing power. Step number 12, it goes from really bad to a whole hell of a lot worse. If policymakers can't monetize these obligations, then the rich and poor battle over how much expenses should be cut or how much taxes should be raised. As a result, the rich will increasingly move to places in which the wealth gaps and conflicts are less severe. At the same time, these government officials losing the big taxpayers will increasingly try to find ways to trap them. So what happens here is we tried the money printing, but the market wouldn't let the Fed do that. How would the market do that? They jack those interest rates up on the long end of the yield curve like we talked about a couple steps ago. Then the government is left with only 2 options: cutting benefits or raising taxes. We know there's a lot more voters down here than there is up here, so they're going to raise taxes. All the rich people are going to say, okay, I'm out. There's no way I'm paying these taxes. They're going to try to get out of the country, and then Elizabeth Warren steps in, and you can see how amazing of an artist I am right there. But, but she steps in and says, no way are you leaving. You're not taking that money with you. And she sets up what I call the financial Berlin Wall, where sure, you can leave anytime you want, but you just can't take your money. And one thing I want to point out to you at home that are saying, well, yeah, but that wealth tax, that doesn't kick in until $50 million. Just remember that the income tax kicked in at an extremely high level at the beginning as well. And that just kept going down and down and down and down. My prediction, because they will need so much money, is if that wealth tax starts at 50 million, within 5 years, it's going to be down to 500,000. Step number 13, the end game paradox. The paradox is at the same time money is essentially free for those who have access to that money, it is essentially unavailable to those who don't have money or credit worthiness, which contributes to the rising wealth, opportunity, and political gaps. Because the quote-unquote trickle-down process of having money at the top trickle down to the workers and others by improving their earnings and creditworthiness is not working. The system of making capitalism work well for the most people is broken. So Dalio concludes by pointing out the fact that all the people in this financial system, the Fed, the government, the banks, a few insiders, not only have access to money, they have access to more money than they even know what to do with. These are the people that I call the financial engineers. And this is this new system that's been created by the Fed. This replaced the old system where the money would flow down to the banks and they would invest that money on hiring more employees, CapEx, growing their business and increasing productivity, making the economy better. Then you have the outsiders. It's everyone else. It's the 99.99999%. It's all of us. You watching at home, me included. These guys have access to more money than they know what to do with, and the paradox is everyone else has access to a very limited amount of money that is decreasing day by day. Dalio says it's because capitalism is broken, but I can assure you, capitalism is not broken. What is broken is the Federal Reserve and the government. For more information just like this, check out this content right here. And if you want to grab Ray's book, make sure you do it through our affiliate link. We'll put that in the description below. And I will see you on the next video.